Thanks a lot, Bruno, and thanks everyone for being here. I will just move this chair. So also a great pleasure to meet you in person, Bruno, because I also know and admire your work, so very nice to meet you in person. Although today I will not talk about ecological, about monetary hierarchies, but rather about a related but different topic, which is the one of central banks and the ecological transition. I didn't know exactly who would be here. I see a lot of familiar faces. Some of you I taught a little bit to some of you. So it's going to be a bit repetitive. So it could be either annoying or an opportunity to refresh, challenge. So take it as you want. But there will be some repetition with some of the things that I've said to you. But I've tried to update that, to present that slightly differently. So hopefully it's going to be interesting as well. Just checking the time. So okay, yeah, I will probably take an hour, but let me know if I'll try, yeah, perhaps to go a bit shortly toward the end. So I start with the key messages. So basically, you have everything in 1 or 2 slides, but the key messages of this presentation and of the paper that supports this presentation, which is a paper that was published, I think, 1.5 years ago, called 3 Tales of Central Banking for the Ecological Transition, I believe. But the key messages, and updated a little bit for this presentation or with recent research, are that basically central banks are really were forgotten institutions in the question of the ecological transition until like 8 to 10 years ago. People who think about the ecological transition or transformation or bifurcation. I will not talk about the different ways of calling it. I will say transition, whatever this entails. But you know, like if you talk about, hey, what about central banks? There are people who say like, what are we talking about? And that was problematic because central banks are extremely important institutions in capitalism in general and in the different regime of accumulation that you see under capitalism. Of course, they don't shape everything, but they definitely contribute to this different regime of accumulation. You know, like from they have impacts on capital-labor relation. They can have impact on real exchange rate, on global trade. They can have like impact on many different things. And therefore, it's very welcome that for the past decades we have seen really a big emergence of this question: what about the central banks? What should they do in this transition? And I think this is a very welcome development. And I'm saying that trying really to forget everything that has been happening for the past few months, because who knows what will happen, but you know, like trying to take a little bit of distance, and yeah, also because I guess this is what's on the personal level what I need at least to do to, you know, like to keep believing in that. And I would say that, you know, like right now the question is that the problem is that under this discussion of like what central banks should do, we have seen like a bunch of proposals, like many proposals emerging. Central banks should do this, they should do that, and so on. And I think it's not easy to understand. The debate become a bit fuzzy at times. So the purpose of the paper that supports this presentation, of some of my research in this field, is to try to say, can we better understand why we have such different proposals, how we should understand them, how we should analyze them, not to say this one is good, this one is bad, but rather where do they belong, what kind of change are they trying to achieve, what are they informed by to reach this conclusion, and so on. And my appreciation, my understanding is that, you know, like the debate becomes a bit fuzzy because we have 2 big issues happening. One is that people have very different views of what a central bank does or should do. And I will try to talk a little bit about that, but it is quite normal because central banks, you know, like they're institutions that have evolved throughout time, that, you know, like don't do the same thing from one country to another. There are a lot of political economic consideration. For instance, you know, like today, if you ask someone who would be a bit more in the mainstream, I would say, and someone who would have a more heterodox perspective, to put it very briefly, you know, like the mainstream perspective would be to say, today we're in the regime of central bank independence, and someone with a more critical perspective could say, today central banks are really supporting a financialized regime of accumulation, and, you know, like for instance, whenever there's a crisis, they will jump in, buy financial assets, save the value of, you know, like the price of financial assets, support it at high level, create inequality. So you could have super different perspective on what they're doing right now, actually. You know, like, are they like helping capital and capital owners, you know, like to get richer through a financialized regime of accumulation, or are they like really independent, as other people say? Very different views. And the other problem is that in addition to have different views on what they do, people also have different views on what the ecological transition entails. So again, the goal of the paper is not to say this is the right view, this is the wrong view, but to say it is really not the same, whatever your view of central bank is, to say the problem of the transition is that we need a carbon price, or to say the problem of the transition is that we need to reach a specific investment gap, or to say it's a complete economic transformation, a complete structural change that we need, or to say we're going to have green growth, post-growth, degrowth. Like, your view of the transition is so different that it will affect the role of central bank, the work of central banks in different ways. So once you put these two things together, what central banks do and what is the transition about, you end up with very, very different proposal. So with this being said, the goal of the paper and research is to do three things. The first one is to start trying to understand a bit better how we can connect these different proposals by saying this is where, like, if you understand central banks and the transition that way, then this proposal makes sense within this framework and so on. And I will categorize three main proposals or three main type of proposition about, like, central banks and transition. And the second purpose is to start, like, discussing a little bit, like, what are the insights, limitation of this proposal. And the third one, I won't have much time to delve into that, but also because this is something quite new and this is a little bit my own proposal, but you say, okay, from there, from the third perspective that I will present, where do we go? Where do we move towards? So that's a little bit the story in a nutshell. So the three views that I propose is to present today are what I call, like, this risk-based approach, the proactive approach, and this, for lack of a better term, to be honest, this co-evolutionary and institutional approach. So in each case, what we do in the paper, I will present that a bit differently today, but is to look at the rationale, what is the understanding of the role of the central bank and of the nature of the transition, what I was saying. Then what are the proposals that emerge naturally from this understanding of both what central bank do and what the transition is about. And then what are the limitations or, or potential limitations of this proposal and of this analytical framework. So, again, in a nutshell, so that I can start delving into the paper, the first view is this risk-based approach is really, like, grounded, and I'm going to simplify things a little bit here because some proposals, they could fall in between 1 and 2, in between 2 and 3, but at the risk of simplifying a little bit too much, I would say that this risk-based approach considers basically that central banks are independent institutions that are market neutral with a very clear mandate, and the transition usually is depicted, presented as, like, an externality, the question of climate change, that can be resolved with, with typical price signals and also through risk assessment. So it's a question of externalities and risk. From there, the proposal would be, like, to measure climate-related risk, see how they can threaten financial stability, price stability, without any change to the mandate. What central banks are doing is right, they have to keep doing it, but integrating climate-related risk. And perhaps this is the beginning, like, how do we include that into regulatory responses, into monetary policy, into financial supervision, to in financial regulation in the future, how do we integrate climate-related risk? And this will have, like, a lot of limitations that I will present in more detail, but it leads us to this second approach, which is what I call the proactive approach, that really says, like, actually central banks are much more powerful than what this mainstream risk-based approach says. Like, central banks they really have the ability not only to redirect financial flows from one place to another, but even to shape, to structure the behavior of financial markets. So they really have a strong power on finance and therefore on the economy. They are not, like, it's not that they fix something by analyzing risk, it's that they shape the market. They're like market shaper. And usually when they talk about the transition, these people would say it's useless to measure risk. This is about uncertainty. We need a complete change. We need massive investments. A lot of things can happen. So the question is, how does the central bank help us to get there? And measuring risk is completely useless. I'm, again, simplifying, but that will be it in a nutshell. So the response of that is, okay, let's activate all triggers that central banks have at their hands. And it can go, like, from very technical issues, such as like we can green the collateral and promote a little bit like a green firms, to like we could have differentiated interest rate. We could have like when you're a central bank, you provide a loan at 1% to a bank that invests in fossil fuels, and you provide the same loan at 0.5% to a bank that invests in clean technology. So this will be, like, and it can go as far as, like direct monetary financing, things like this. And I would, it's quite debatable, but I would place them in the same category, where whenever the proposal comes from like saying like the central banks have to help and push the frontier. And the third view, it's somehow like a bit more, the territory is a bit more unclear, but this is the one I think I assimilate or like feel a bit more affiliated with. It would be something where like it's not about denying the power of central bank. It is a very powerful, important institution, but it is, the idea is to say it is always important within a specific institutional framework, within specific institutional arrangements. So basically we cannot consider central banks like in isolation, saying, oh yeah, central bank can do this and can do that. Like it always depends on what other players would do. A typical example, just to spoil it a little bit, not related to climate change, would be to say, if we talk about the recent inflation we had, for instance, like central banks have increased interest rates. I don't want to get into easy debates whether like the inflation had to do with stuff that central banks could control or not, but at the very minimum, to put it in non-controversial way, the sources of inflation were related to shocks that the central banks has little control over. So part of the response was, for instance, related to like the control of energy prices, for instance, in France, in many countries, we saw that. So this is not something that central banks does, right? So the central bank could increase interest rate. Whether that was a good thing to do or not is a separate topic, but it's like whatever they do, this question of price stability doesn't depend only on them. So they need to work with other players. And this question of the transition in this co-evolutionary approach, the question of the transition becomes very different. Sure, there's uncertainty. Sure, we need to close an investment gap. But you can ask the question differently about what are the different scenarios? What are the capital-labor relation within the transition? Will there be more or less inflation? Some of the people here are going to work on that. What are the inflationary impact of the transition? What are like? Are we talking about a regime of like GDP growth or degrowth or post-growth? And all these things will completely change the role and like the work of central banks. So the question would really be to have like something, it's a proposal, like it leads you to proposals that are perhaps a bit less clear, although you can make also concrete proposal, but it's more like an interpretative lens to look at, like how does the central bank should behave in the transition. So it was a long overview, but I think so it will be easier to like to understand a little bit what I will be discussing. And for backgrounds, I wasn't sure about who would be here exactly, but like knowing that it is, as far as I understand, only EPOC students, I think that I don't need to make the case that like we're living through an ecological crisis and so on. So I suggest to just skip, like it's very, very bad. I think we'll agree. Yeah, I see people nodding. So you probably had I don't know, like 20 professors explaining the same before they start, but just saying like, this is bad, we need to act very fast, very radically, and it's not climate change, it's planetary boundaries, it goes much beyond climate. That's it in a nutshell. So from there, one could say, okay, so what's the role for central bank, like in all this, like ecological disaster? Why would central banks care about that? And this is where like this view one that I was presented is, before we get to the proposal, we need to understand this view one is the one that was put forth mostly by central bankers themselves over the past decades. So what was the analytical framework from which they came to say, yeah, sure, we should care about climate change? So how do they see themselves, or how does the mainstream, let's say, to put it that way, to simplify, how does the mainstream see the role of central bank? So there's really this idea that central banks, the mandate, the practices of central bank, like take place within a strictly defined parameters characterized by independence, by market neutrality. And usually the core mandate of central bank is price stability. Like there are some debates about what does price stability means. Is it like there's an agreement today, consensus around 2%, but is it like strict? Is it 2% over time that you let like periods where it's a bit above, periods where it's a bit below? But usually there is this idea that like we need to activate monetary policy, and that monetary policy would be, because that's what these people would believe, would be the main contributor to price stability. by setting interest rate higher or lower, of course, but also through a bunch of different activities where central banks, they on a daily basis, they have multiple operations with commercial banks. They provide loans, they can provide like targeted loans. They have the collateral framework. Whenever they provide a loan, like they take collateral from the commercial bank. So like there will be also ad hoc operation during times of crisis and beyond the crisis, such as quantitative easing. So a lot of things that are done under this umbrella of monetary policy, and that is always with this goal of achieving like 2% inflation, or what is called price stability. But central banks tend to also say that financial stability, even though it's not always clearly indicating their mandates, that it is part of their DNA, with this idea that if you don't have financial stability, if you have like crisis of liquidity, there's no way you will have price stability. So you need to have financial stability to have price stability. And therefore, central banks are also present in supervision, prudential policy, liquidity provision. For instance, central banks and financial supervisors are, like part of the Basel framework of the BCBS, the Basel Committee for Banking Supervision, through which, like capital adequacy ratio and liquidity ratio are established for banks. Like you say, okay, a riskier bank, I'm going to ask the riskier bank to have more capital than, like a less risky bank. It also needs to have more liquidity in times of crisis. Central banks conduct the supervision of financial institutions. It can be conducted, for instance, at the European level by the SSM, which is a European, like it's at the Eurosystem level, where they supervise the systemic banks. And when it's not systemic banks, in the case of France, for instance, it would fall under the ACPR, the Autorité de contrôle prudentiel et de résolution, which is part of the Banque de France, the French central bank. And then, of course, central banks are also lenders of last resort. This is there's a lot of literature on that, and like by acting in time of crisis, they're also like guarantors somehow of financial stability. And lastly, there is within this mainstream view the acknowledgement that central banks, like they can also support the government or other goals, but usually it's really seen as a secondary mission. It's really whenever there's a trade-off, they will go to I guess, should I allow or deny that? You never know. Confidential information, I will rather deny. Okay, let's see. So, for instance, in this secondary goal, it's very clearly defined in the case of the ECB. You have an article on the Treaty of the Functioning of the EU that requires the ECB, the European Central Bank, to, and I quote, support the general economic policies in the Union with a view to contributing to the achievement of the objective of the Union as laid in Article 3 on the Treaty of the European Union. And in the case of the Fed, the US central bank, like there's a dual mandate, a double mandate of price stability and employment. But in practice, and the case of the recent episode of inflation was a very clear case in point, whenever there's a trade-off, usually price stability takes over employment with like declaration from, for instance, central banker Jerome Powell saying like, yeah, we need to increase unemployment so that we can control prices, which didn't happen for a whole different reasons, but that was like the initial, in their initial acknowledgement, they were accepting to raise unemployment so as to achieve price stability. So it's really the core. So with all this being said, and sorry for this a little bit long introduction, but this is how central banks came to the question of climate change, basically. First, climate. I will say a lot of climate change because like this is where most of the work has been taking place, even though in the past 2-3 years, they have also worked a little bit on biodiversity, other environmental issues beyond climate change. But the first very well-known speech was by Mark Carney, who was at the time governor of the Bank of England, who basically says, like once climate change becomes a defining issue for financial stability, it may already be too late. So there is this in this speech called "Tragedy of the Horizon." There is this idea that that basically central banks can and should work on climate change so as to guarantee financial stability. And hedge the financial system from the risk posed by climate change. And this is also very clearly put in the language of Christine Lagarde from the ECB, where she says, and I quote, even without changing our mandate, climate change has an impact. It has an impact on how we model the economy going forward, how we forecast, how we measure risk, how we stress test institutions, how we value the collaterals that we receive. So this is really like this risk-based approach that you can see shaping up. I think in practice, central banks have also been influenced by a broader context with the Paris Agreement, which in 2015, for the first time, the climate negotiation mentioned explicitly the importance of finance. There was a huge increased interest that has been reverted recently a little bit, but private finance was very interested in climate-related issues. So I think that central banks have been influenced by that. But here, in the way they presented it, it's always about, like this is us as independent institutions caring about this risk. I will pass that quickly, but just to say that central banks have created a network called the NGFS, a network. I think it had or it has 143 members, because you may have seen that just a few days ago the Fed withdrew from the NGFS. So, which is also interesting for an independent central bank. They joined just when Biden won. And they're leaving just when Trump wins. Very, very brave of them, we could say. But yeah, they're out of this NGFS, which is like really a network that focuses almost exclusively on assessing these financial risk caused by climate change. In practice, we distinguish two kinds of risk, what are called the physical risk and then the transition risk. So the physical risk are the shocks of climate change itself. I won't talk that much because for me I will focus a bit more on transition in this paper, but basically physical risk are like the fact that we're going to see either chronic or acute shock with climate change. Like we can think of a lot of examples of flooding, recent wildfires, so on, that can create a lot of impact at the micro level, like on businesses, on households. We're seeing that now in Los Angeles, and also like with macro impact that can result from that. And then you have transition risk, which are like all the changes needed in the economy. So like the most narrower version of that is like you have carbon price that's going to impact businesses in very different ways. But you could also have like the question of stranded assets that you may have heard of, that like if there's a transition, a rapid transition, a lot of existing fossil fuel reserves would have to stay in the ground, and like this could change like a lot of changes in the price of these reserves. So it could impact financiers, but it could impact also different sovereigns. For instance, fossil fuel exporters would no longer be able to export. So like this would have a lot of macro impacts. And all these micro and macro impacts could then translate like into financial risk, in the sense that you have banks, insurers, investors exposed to all these activities. So it can translate into credit risk, like a business impacted by climate change that is not able anymore to reimburse a loan, for instance. It can be market risk, for instance, like with a sharp, sudden repricing of equities in the case of stranded assets. It can be underwriting risk. We're talking quite a lot about that these days with the fires, the wildfires in Los Angeles, where there are a lot of issues of houses, both houses that were insured. And basically, insurers and reinsurers are very concerned because they hadn't priced that in, like such wildfires that would destroy property with such a high value. So it's quite a concern. But we're also talking about the houses that are not insured, which is also another type of financial risk. The risk is not for the insurer, for the underwriting risk, but it becomes a credit risk, because many of these households were still, I can pass it on if you many of these households were also like indebted to their bank, so it can translate into a credit risk. So this is a little bit the analytical framework, basically. So the way central banks would proceed then is that, okay, we need to understand this risk. I will move a bit quickly, but there's this idea of like climate, you may have heard climate stress test. Usually central banks, some of them, they talk about that. The Fed, I think, in the case of the ECB, they talk more about scenario analysis, but the idea is to, okay, how do we measure this risk then, the three I presented here? So just to say that you cannot look at historical data, because it's not going to tell you like about things that have not happened. So basically there's really this focus on scenario analysis, which is the questions like what is the narrative? So basically, what kind of target? If you have a 4 degrees target, you would have a lot of physical risk. If you have a 1.5 target, you will have lower physical risk, but perhaps higher transition risk, and so on. Then what is the timeline? Do you assume that the transition takes place in a very smooth way, that it starts today very abruptly, that it starts in 10 years from now quite even more abruptly? So you could have like different different views. Then we need to have a lot of tools, basically models to analyze the economic impacts of this initial shock. You want to model that, and then at the third step, you would have you would measure the financial exposure and vulnerability to these impacts. So it's just repeating a little bit the previous slide with this view of scenario. These are just to show you a little bit, that quite a few central banks, ACPR, so the French supervisor, which is part of the French central bank. You have the Fed, you have the ECB, you have others that have been developing that. I won't get into that. That's one exercise I had contributed to when I was at the ACPR, the French central, the supervisor of the French central bank. But basically, what you find, and this is the beginning of a connection with the next section. Although we'll talk about other things here in the first section, but what you find across all these climate stress tests, so to say, is that the risk are not really high, actually. Whether it is physical risk or transition risk, like all central banks find oh yeah, sure, a few sectors could be exposed. There could be some vulnerability here and there, but basically climate change and the transition to mitigate climate change are not basically a game changer for the financial system, according to these studies. It's not me saying it, just so that I'm not misquoted. And then we'll get to that, actually, because this has been one of the contending points that will lead the view that I call the proactive approach. But for now, just to say that the vast majority of the work by central banks has been on financial stability, how does climate change affect financial stability? But now there's more and more work on the question of price stability, to say, if the core mandate of price stability could also be impacted. So there are some studies. This one is not produced by central banks, but it's to show that with the increase in temperature, you would have huge impact on agricultural yield, and therefore the price of food could be increasing in the next years. So for instance, this is a world map with estimate from these authors in a recent, quite interesting paper about what is the annual pressure on food inflation in 2035 under different scenarios. That's one of the scenarios with regard to physical risk. So what you see is an overall increase in the price of food that could be estimated for the next decade, basically. And you could, this doesn't even account for a second round and so on. But basically what it means, okay, this could become a recurrent problem, this question of food inflation. So how should central bank work on that? The historical approach of central bank would be to look through food and energy inflation, to say this is very volatile and so on. But if this becomes persistent, and you have it every year, you need to change the way you look at it. Same for energy. And this table, it comes from a report of the NGFS. I won't summarize the whole table, but it's just to show that the NGFS is starting more and more to think about that, about how does the transition impact price stability as well. So they make some assumptions. Again, this is debatable. For instance, carbon pricing, what they consider the impact of inflation, they would say that headline inflation, so including energy and food, it would move up temporarily while core inflation would not be impacted. So if you have a carbon tax, basically, or carbon price or carbon tax, that it can increase the cost of energy, especially in countries that have a lot of fossil fuel-based energy. Then if you look at for instance green subsidies, they would say the prices in subsidized sectors are likely to fall. For instance, a very heavy support to renewable energy, but then the overall impact on inflation is quite ambiguous, because this could lead also to a lot of other macro impacts that could end up having prices impact on inflation. For instance, also if you look at green innovation, there's this idea that it could reduce cost and therefore dampen inflationary pressure. So you could have also scenario where you'd have a carbon price that increases energy, but then also green innovation that creates kind of downward pressure or disinflationary trends. So there's ongoing work now by central bankers to say, okay, we need to have a clear view on whether different scenarios could be inflationary, deflationary, disinflationary, where does it go, basically. And lastly, central banks don't really like to talk about that, but that will be the next step, of course, about, okay, once you have measured all these risks, then you need to integrate them into financial supervision, so financial regulation, monetary policy. So what are you going to do? And here we're starting also like progressively to see a little bit of work here and there. First, in the case of financial regulation, I just put here Basel III. So Basel Agreement is basically this the latest set of international standards for banking regulation in particular. So the most important part of Basel III, the third, I would say, version of this Basel Agreement is that what the Basel III was after the 2007-2008 financial crisis. This is when it was started, and it was sort of finally approved in 2017. So the first part is that this pillar one is the most important one, that when you're a systemic bank, or depending on level of risk that you have as a bank, this is measured by how big you are, how complex your products are, in how many jurisdictions you have activities and so on. But let's say that very big banks with activities all over the world are very risky. They need to have more capital aside than they used to have in the past, and they also need to save to have more liquidity or liquid assets in case of sudden shock, basically. So the idea is really to ensure that the banks have enough capital and enough liquidity to respond to a liquidity crisis and to avoid the contagion of the shock to other banks, as we've seen during the financial crisis. So you could say in the future, this is not done today, but you could say, okay, tomorrow you could say that a new criterion would be if you're more exposed to, if you're more exposed to climate-related risk, well, you're also more systemic, so we're going to ask you more capital. So this could become a topic. But for now, the few examples we have are more like Pillar 2 and Pillar 3. So Pillar 2, it's more about how it's a bit more discretionary. So you want the banks to have good risk procedures, and you could, as a supervisor, say, okay, this bank, it's not measuring anything related to climate-related risk. So you could say, as such, it also needs to have more capital, to put more capital aside, because it's not doing its job. In practice, for instance, the Brazilian central banks require commercial banks to incorporate environmental risk in their governance framework. So there are examples here and there where you can see the supervisor, central bank, requiring the commercial banks to integrate this risk. And then the pillar 3 is it's more about disclosure. How do you disclose that? And then you have a few examples, especially in the EU with the CSRD. It's the Corporate Sustainability Reporting Disclosure. You may have heard of it because now a lot of people want to dismantle that completely. And it's, very, very positive days, right? And basically it's this idea that financial institutions and non-financial corporate as well, they need to disclose on climate and biodiversity related risks. So they need to send that signal to the market. So it's still very much market based. Same with climate related monetary policy. There's not much today, but the idea would be to say once we have measured this climate related risk, we could integrate them into everything that the central bank does. So whenever it provides a loan to a bank, it will need to adjust this loan to whether the bank is more risky or not from a climate related perspective. The collateral framework. So the collateral framework is every time the bank provides a loan to a commercial bank, it receives in exchange some collateral, which is just to show, to cover for the risk of default of the bank, basically. And this collateral, you could say, don't give me collateral that is related to fossil fuels. Give me green collateral. So that you could do that. And then the asset purchases. This is not really in fashion today, but it was super important following the financial crisis, where central banks have been doing a lot of quantitative easing, corporate purchases, and so on. So they could integrate climate-related risk into all of this. And in fact, there are a few examples. The ECB, for instance, the ECB collateral framework, it's been going up and down the way they've implemented it, but they have committed in 2022 to limit the share of assets issued by entities with a high carbon footprint. That so basically, this institution could not pledge too much collateral related to fossil fuels when they want a loan from the central bank. So this is just to say that a lot can take place. So one could say, perfect. This is that's the way to go. Keep measuring the risk, improve your risk assessment, and we'll get there. But I guess you guessed there was a different way of looking at it, and I will move a bit faster for the second and third view because a lot of context was needed for the first one. But the second view is very different. Like what I put in blue, sorry, it's not super clear, but it's just, like, just to emphasize a little bit different views of, like the first slide before of view one was to say, like the central bank was independent, and here, perhaps from a more heterodox perspective, like people say, like, it doesn't matter to say the central banks are independent, because in practice they have such a powerful influence on the direction of credit, on the behavior of financial markets, that like this will have like multiple influence. So you can say you're independent, you can say you're market neutral, such things don't exist basically. And for instance, like there is this idea, like we talked about price stability when you set interest rates. Well, when you set interest rate, this has a lot of impact on the ability of different players to borrow. And one thing we are observing now is that with the recent rise in interest rates, it has made the financing of renewable energy much more complicated, because these are typically projects that are considered to be more risky. So interest rate tends to be a bit higher. They tend to be very long term, and in many cases they don't have like such high rates of return. So for them it became very difficult to get access to credit. So you could say just by increasing interest rates, you're no longer neutral, you're delaying the transition. That would be one perspective. Same with like the different operation with a central bank, with commercial banks, like that when you provide collateral or when you provide like short-term loans to the bank, like you may be reinforcing the status quo, because you're like helping banks without asking anything for anything in return. And then in case of emergency, we saw that during COVID, like central banks jumping in, buying a lot of assets, and you could say that this reinforced inequality, because you have like unemployment going up, activity stopping, but owner of financial assets being like saved by central banks, basically injecting liquidity again and again. Say all these impacts happen. Same with financial stability. Like you could say that if you just provide liquidity in case of crisis without any environmental requirement, you're just like also pushing for the status quo. And then these people say that like the support, the ability of central bank to support government or other goals, like it could be mobilized much more than it is now, that it is possible to go much further. And usually what these people say, that's for like their view of the central bank. And when they work on like, okay, what about these risk assessments that are being done? What they say is that like all these risk assessments are a bit meaningless, because like you could spend a lot of time like trying to look at, okay, how does it look, like if climate change occur in the next decades, where would it have an impact and so on. But like, what do we know really about like which next wildfires, the next flooding and so on? So what they say, it's much more about uncertainty, about potential major risk that the current models are vastly underestimating. And here I used, in the interest of time, to be honest, a little bit of a Svartzman argument, but there's a lot of attack usually to the DICE model, which is the one developed by Nordhaus, with which he got the so-called Nobel Prize in economics. And like that basically say, even with crazy levels of global warming, the economy is doing just fine. And this is for a variety of reasons, because of the activities that are, according to the model, would be impacted, because of the discount rate, because of the way in which secondary effects are not captured and so on. But basically, like it would be unfair to say that all economists work with that, because that's really not the case. But there is, like this idea that that when you want to do risk-based assessment or cost-benefit analysis, you're really missing the big point, which is that we could have like terrible impact with multiple tipping points that are connected across each other, like one ecosystem crossing a tipping point, not being able to regenerate, having an impact on another ecosystem. Like you see how the Amazon rainforest is connected to El Nino, and how like in the end, all these big biomes in the world are connected. So the questions are, how do we avoid that? And like, and many economists have been saying we should rather work with a precautionary principle. What do we do to avoid that, than like trying to look at, hey, how bad is it gonna be? And on the question of transition risk, one could say, well, actually transition risk, there's less uncertainty than physical risk, but there's also this idea that like you still have a lot of uncertainty. Like, do we want to spend our time like measuring risk, when in the end, like, do we really know what the energy matrix will be in the future? Will we have like more nuclear, more solar, more wind? Like that would change your entire analysis, and you don't know really how many investments are needed. Like the amounts can vary a lot and so on. I'm going like quite quickly through that just to say that I will not get into all the arguments made there, but there's really this idea that you know, like, sure, we could improve the models, we could better measure the risk and so on, but fundamentally, there are two things. First one is that today, we're underestimating how bad things could be, and these are just a few examples of reports and news articles that came out over the past few years criticizing the NGFS scenario, saying, you know, like, they're really completely underestimating the risk. And the second issue is to say, even if you are using better models, you measure the risk a bit better, if that's possible, and so on. Where does that lead you, really? And you're like, what does it mean to have a good risk assessment if you're a financial institution or central bank? And here, there's like in this famous quote by Mark Carney, who this is not Mark Carney, but he mentioned here. You know, like, there's this idea that, you know, like, he says, like, there's an old adage that says that which is measured can be managed. And in fact, there are two issues there. That some of the risk cannot necessarily be managed, really, when we're talking about huge physical risk, about, you know, like a risk that when you have, you know, like a sea level rise. Okay, what are we really going to manage? But even if you could really mitigate the risk, what does it mean? If you're, for instance, an insurer, and this is something that we're already observing, you are an insurer in a zone where you know that wildfires are coming, hurricanes are coming. So what do? As a good risk management procedure, you can increase the cost of insurance, for instance, of the insurance policies, or you could just say, you know, like, I'm out of here. And the problem is that by doing that, it's very rational at the microeconomic level. But in fact, you're only displacing risk to other agents, to the firms that is no longer insured, to the households that is no longer insured. So basically, you know, like, this is not like a good risk management from a macro perspective. So there is this idea that you know, like, that measuring risk is the thing to do. It's like, for what? What action would you take that in the end would be better for everyone? So there's a discrepancy here. It could be some sort of, you know, like, you know, like, you have a lot of that in post-Keynesian economics, right? Things that, you know, like, that's an effect of composition between the micro and the macro levels, and you could see it that way from a climate-related perspective. This literature also that emphasize this question of the limitation of the risk-based approach. They also emphasize usually a concept that is called double materiality, with which personally I have a few issues. But basically, the idea is to say the financial sector, it's not only suffering from climate-related impacts, from climate transition, physical risk. It is also contributing to them. You know, like, you could take like Bank A and say, oh yeah, Bank A, poor them, they're really exposed tomorrow. You know, like, if there's a transition, they have invested in a lot of fossil fuels. Actually, they are investing in fossil fuels. They're buying this risk for the future. So there's really this idea that, you know, like, that's by emphasizing so much the risk-based perspective, it's a way of kind of like not accepting your own responsibility for the whole mess. So basically, it's another limitation of this risk-based approach that is often emphasized. And it can be applied to, you know, like, financial supervision and regulation. For instance, in France, I mentioned this CSRD in Europe, and in France, there's this French law. It's Article 129 of the Loi Énergie-Climat, and then a decree of like a specific text, décret d'application for a French speaker, like a specific text that explains how to implement the law. And, you know, like, now it is requiring corporates and financial institutions in France, beyond a certain level of activity, employees, assets, and so on, to disclose not only the risk under the Pillar 3 of Basel that I showed before, but also what impact they have on climate and biodiversity. So basically say, sure, you can measure the risk, but you should also just disclose how you are impacting your climate change, how you're impacting biodiversity, because this is an information on its own. You could apply this concept of double materiality to monetary policy as well, to say, you know, like, as I said before, when you increase interest rates and you're delaying the transition, what happens? And this is just a, you know, like a funny exchange from a tweet by Isabella Weber a few months, I believe, ago, yeah, almost 1 year ago, where, you know, like, there was a hearing. And a congresswoman asked Jerome Powell, the chair of the Fed, the US central bank, you know, like, some say higher interest rate hamper the investment needed to tackle climate change. Is that true? And Chair Powell says, it's not our job to consider the effect of high interest rate on climate change. So you could say, this is problematic. This is some sort of double materiality. Like you can say, central bankers, I'm looking at the effect of climate change on interest rate, but not the impact of interest rate on climate change. And then I took a picture of this part, because when he's doing that, he says, and by the way, it's very, very little, the impact, like, like it's, which is a very random response. Like usually you should have like some grounding and references and so on, but like it's kind of like, yeah, and I'm sure it's very little, and he does like this just to get out of this question. So once you have like this this proactive approach, what kind of proposal can you get to? What do you want to work on? What do you propose? And here we have like quite a lot of different proposals. I try to make it like as simple as possible with a little design, but the idea is to say you don't need to do crazy risk measurement. Right now you could activate a bunch of channels, a bunch of measures that would help shift financial flows towards a different direction. So like, for instance, when the central bank provides a loan to the commercial bank, it could easily say, like I have like dual interest rate, basically, like with higher interest rate for banks that are contributing to fossil fuels through this to the financing of fossil fuels, and lower interest rate for banks that are financing more the green transition. So this will be typically grounded in double materiality, which would be, why would you measure risk when you know that this bank is increasing the future risk? Just charge them a higher interest rate, period. Then there's also proposal, like as to like how do we green the collateral. So as I said, whenever you provide a loan to the bank, in exchange, a short-term loan, in exchange you ask for the commercial bank to give you a collateral in the case of default. And here you could say as central bank, I'm not going to measure risk. I just, like I don't want fossil fuel as collateral. Don't send that to me. This is not safe. But I will accept green assets. So this is something that they could do. Then you would have like this question of capital and liquidity ratio for bank. Like how much capital, how much liquidity they should keep with themselves. Same thing, like you could say, don't need to measure risk here. Like if you're investing a lot in fossil fuels, I want you to have like super high level of capital that that you need to keep with you, and I mean super high level of like capital adequacy ratio, or very high levels of liquidity that you cannot invest because you are contributing to systemic risk. Period. Then you have more radical proposals as well, where like the central bank could also try to support like green sovereign bonds. For instance, like it could like buy these sovereign bonds from the governments, or like from public banks issuing the bonds. You have some proposal by Mertens and Tiemann, by Mertens and Tiemann, saying like you could have the EIB, the European Investment Bank, issuing bonds, and then like the central bank kind of like going for this bond on the secondary market, so so basically lowering the price of these bonds. Or you could even have some people are talking about directly monetization of debt, so you would even avoid the commercial banks with very radical proposal, cancellation of public debt, and I would place these people would not necessarily agree to be put in the same category, but the reason why I suggest here to put them in the same category, because what they have in common is really to say, hey, right now the central bank can push things forward. It can really help make the transition happen. And I will try to spend a little bit of time on that, and I have a few, I think, differences with this view, and this is where I think that a third view is quite interesting, like a bit more based on this institutional approach or co-evolutionary approach, which is to say that, sure, central banks has all the powers that we just mentioned. They could do all these things that I just explained. Like, I have nothing against this proposal. But what are we talking about really? Is it, how much power does the central bank have? How much interest is there in doing that? What kind of trade-off could emerge? And here you can have like a third view of central bank, which acknowledges the power of central bank that I showed before about shifting financial flows, about shaping the structure of financial markets and so on, but that also recognize that whatever they do, they never do it alone in isolation. And in fact, there are many things that they cannot do. When we talk about price stability, I hinted to that a bit earlier on. Actually, they had on the recent episode of inflation, central banks increased interest rates, but they had very little power over the sources of this inflation. They had very little ability to solve that. So like unless at some point like you destroy so much demand that yes, you're going to bring down inflation, but it was a supply shock. It wasn't at all a question of like a wage price kind of spiral. That was more like, I mean, it's debatable, but like many people saying it was more like a price profit kind of spiral, if any. So there's really this idea that like central banks, sure, they can do certain things, but there are many things they cannot do, and whenever they can do them in coordination with others. They could say, I would increase interest rates if this price profit spiral, for instance, at some point generates such increase in wages that could create other type of spiral, but then I would act. But like we need to act in coordination with the government. So the idea is really to to nuance or more than nuance, to resituate a little bit, recontextualize how central banks work, what they can do, and why basically they never act alone. To put it differently, one criticism I have to most of the proposals that I presented before is that they tend, and I say that with like I have some friends and good colleagues there, but I would say that there's perhaps a tendency to overemphasize how much central bank could do, and forget a little bit about like the whole institutional environment in which this has to be done. Same with financial stability. Like of course, financial, like they can do a lot for financial stability, but like there are many things that can contribute to financial stability that don't depend directly on central bank. For instance, like there are very few proposals in general in this whole literature on like the recycling of savings, like, and this is super important if you talk about sovereign debt, for instance, debt sustainability. How is public saving in one country reinvested or not in sovereign debt? So instead of talking about, you suddenly say, oh yeah, the central bank could cancel the debt of the government and do this and that. Sure, why not? We can have debate on that, but aren't there like better ways through which public debts could be maintained, like not even, I'm not talking about the level, but through which like we could have, we could achieve like debt sustainability without necessarily resorting to this very extreme or very radical central banking proposition. So there's really basically this idea that we need to move beyond a little bit this central bank independence versus proactive central banking kind of debate. And there's a risk a little bit of mobilizing central banks in a vacuum, basically. Wanting central banks, sometimes I think not consciously, but wanting central banks to replace all other players. So basically what I'm saying is that this precautionary approach, it tends a little bit to have an implicit assumption that the only problem with the transition was the access to finance, as if that was like the one thing that is the problem. Oh, if only we had access to finance, it would work. And then the central bank can push that. And the fact is that, like when interest rates were super low, or even negative in some countries, like the transition was also not happening. So of course, increasing interest rates damages like this ability to get green credit and so on, but that was not the main concern. Or like in one paper I work on here, I won't have time to present it, but that was a paper I worked on when I was at the Banque de France, and at some point like we tried to say, hey, let's look with the collateral framework how green it could be. And then like we had like ways of classifying the firms and so on, and at some point what we find is that there's just no asset available. There's no green assets, because the economy is not green. So what are you going to green as a central bank when when the assets at some point are either not there, or that they become so rare that you would put at risk your ability to conduct your monetary policy in a normal way. So these are things that are not discussed. And something perhaps even more important, that when you focus so much on investment gap, you forget very essential stuff that this whole proactive approach doesn't really discuss. So for instance, what about a scenario where we talk about a just transition where we want salaries to increase? So to say, hey, you know what, we want as part of a transition to have somehow like a price wage potential like spiral, or a little bit of inflation created by wages for low wages. Then what does the proactive approach say? Should we increase interest rate, or should we then keep them low? They have no response on this. Same with different scenarios. Do we have more GDP growth, less GDP growth? how would you react? Does it change anything? No response, because everything is focusing on shifting the financial flows. And I think that this is a bit problematic, actually. Another issue that is not discussed is like what I call here like the geopolitics of central banking. But basically, I mean, I wasn't here when Bruno presented, but it's probably very much related to discussion of like monetary hierarchies. Like, you know, like aren't all these proposals also very much based in a world of you know, like kind of like core countries at the top of the periphery making proposal, but you know, like for instance, we know that you know, like whatever the Fed does has like a global impact. So how do you think about this global impact? No word on that either. So all these things I think are really much missing in this proactive approach. So I'm almost done, but yeah, and I see I have just a few minutes left. But I would say that you know, like the good news is that I think we're seeing like the very beginning of a new debate now, where we have a few authors here and there saying like, oh yeah, actually it is about coordination. It is about you know, like how the central bank could become an important player within a specific framework of fiscal monetary cooperation. So we have you know, like some papers by Daniela Gabor talking about this idea of you know, like coordination without subordination. So this idea that we need to move from monetary dominance, with like central banks are too powerful, to a situation where fiscal policy becomes like predominant again, but central banks still trying to help this fiscal policy to take place. So she has a few proposals on that. Katie Kedward and colleagues, you know, like they call for like explicitly to revive post-war credit policy regime, you know, like so, and you know, like where basically you have different ways for central banks and governments and other stakeholders to work together, try to steer credits towards certain priorities. So I think like we are sort of getting back to that. Perhaps the most well-known proposal was made by a French a great scholar called Eric Monet, where he talks about, in the case of the EU, this proposal of like a European Credit Council, where in his own word, I quote, it will be a deliberative body aimed at strengthening parliamentary power on monetary and credit policy. So we're really talking about basically putting monetary policy and credit policy of the central bank at the service of something broader, under the control of the parliament. So it's quite strong. It's a technical term, but it's really about democratizing central banks, basically. And this body would be like aimed at strengthening parliamentary power on monetary and credit policy, the democratic legitimacy of central bank policy in the euro area, as well as its coordination with other European policies. So there's really this idea of of pushing for this idea that central banks can do a lot. It's not a way, the criticism to the proactive approach, say no, central bank actually they're not that powerful, they could not do that, but to say, when could they do it? In which context? How? What kind of challenges it would bring? And I think we're at the very, very beginning of that. For instance, the proposal that I presented before by Daniela Gabor, Katie Kedward, and Eric Monet. And you're like, I really appreciate them on a personal and professional level, but I would say it's not a fundamental criticism, but to say we're still very, very new in this debate. So there's still like for instance, in Eric Monet's proposal, I think there's a genuine belief, basically, that like deliberative democracy, that you put central bankers, industrial, some like industrial owners, you put some financiers, governments, labor union, trade unions together, and that they would naturally like somehow steer the economy toward the right direction. I think there's a strong belief in this idea that like that's. Yeah, maybe if you come a bit more from a perspective of like class conflicts, things like this, you would say that like, why would this credit be in favor of labor versus capital, for instance? Like, why would it fund like projects with no return over the long term? So like it's, I think there's still a lot of work to be done. Also, the criticism made before, like if you're in a scenario with like no growth, like how do you deal with that? You would still have you may have a reaction from firms like trying to make profit in different way, with more financialization, with like increasing prices, like to compensate for the lack of sales. And you're like, okay, what does this credit council do in that case? There is a conflict of interest. I mean, a conflict between different interests. Sorry. So yeah, it's just to say that like we're still at the beginning of that, but I think that this is a much more interesting way to proceed. That can lead really to more enlightening and perhaps more insightful discussion and policy proposals. So yeah, that's it in a nutshell. So just to summarize, I would say like this is super welcome that we're now talking about central banks and low carbon transition. When I started my PhD 10 years ago, like this was, like, yeah, when I would say that I was working on that, people would look at me saying like, what is even this topic? Like it's a lot has changed, and I think this is really, really welcome. But as I said, I think the discussion had become a bit fuzzy because like the central bank is such a complex institution, and the question of the transition is so complex that people come with very different views that sometimes like it's implicit in what they say, but like it's necessary to kind of like make that more explicit to understand who's saying what and why. And hopefully the presentation help like to disentangle a little bit to like these different proposal with this categorization that is surely debatable, but like between these three risk-based, precautionary, and more co-evolutionary approaches. And the third approach is one that I believe quite a lot in, but like that acknowledges the power of central bank while really like needing to clarify what scenario you're working on. Like, is it more industrial policy? Which one? Which technologies? What kind of like north-south relation? What kind of like what GDP growth rate are we talking about, and so on? So, and like it can even lead you to like to quite strong criticism of capitalism, because like you could have like transition of scenario. Scenarios of transition where like you could say that like you're talking about decommodifying critical needs and so on. Okay, all this would have price impact, financial impact. So there is I think, a much more fruitful avenue to work on the role of central bank with this mindset. Even though I recognize by doing that, it doesn't lead you to like to kind of like crazy to like super fancy proposal to say here's my proposal to solve all the problems of the world. But I think it's a more interesting interpretative lens to understand different possibilities. And I'll stop here. Thank you very much.